Good morning, ladies and gentlemen. Welcome to our webinar forum this morning. And good evening to Dr. Sinai. Thank you very much for joining us at this historic day of President Biden's inauguration over there. Today, we are most fortunate to have a distinguished speaker, Dr. Sinai, who is joining us live from Boston. Dr. Sainai is, as you know, one of the most respected experts on economic forecasting field. I'm confident that his insightful views will help us better understand the outlook for the US and global economic recovery, as well as financial market trends this year. Currently, Dr. Sinai is Chief Economist, Strategist, and President at Decision Economics Incorporated. He had served as Chief Economist and Managing Director at Lehman Brothers, Senior Vice President and Chief Financial Economist at Data Resources Incorporated. Dr. Sinai won top forecaster from Wall Street Journal survey and USA Today survey in the past. He's a graduate of the University of Michigan and holds his PhD from Northwestern University. Without further ado, let's welcome Dr. Sinai, who will speak for about almost 40 minutes, as I understand it, followed by our Q&A session until 10 a.m. here in Seoul time. Ellen?
Well, thank you very much.
I like your hairstyle, actually. You have changed over the last 1 year since we last met in Seoul.
You know, I am isolated. I'm very careful. And I have not been to a hair salon because it's a little risky. And I am in that very risky age group. So what I will do when it's over, I think I'll take a vote and see how people, whether they like it this way or the old way. So I know I'm a bit unrecognizable to some, and I apologize for that. But COVID has changed our lives. And I want to thank you so much for the opportunity to speak with you and to the audience. I am usually in Seoul at this time each year, perhaps going back 25 years, and I miss very much the in-person interactions at breakfast time that I've had all these years in Seoul, Korea. One of the highlights, always one of the highlights of the travels during so many years all around the world. But that's not happening now. I'm not traveling and speaking to you from my home in Lexington, Massachusetts, and delightfully so. We are looking at the US and global economic and financial markets outlook for the coming year with a subtitle, Picking Up the Pieces and Putting them back together again. And I have a little nursery rhyme poem to recite to you as an introduction, I hope with tongue-in-cheek and some humor. It's a famous English and American nursery rhyme. Humpty Dumpty sat on a wall. Humpty Dumpty had a great fall. All the king's horses and all the king's men couldn't put Humpty together again. Well, in the last 4 years, Humpty Dumpty sat on a wall, a great wall separating the United States and Mexico. The year of the pandemic, 2020, knocked Humpty Dumpty off that wall and the wall down. And Humpty Dumpty had a great fall. And no matter what he tried, there was no way he could be put back together again. And it culminated 2 weeks ago in something very unusual in the United States, essentially an insurrection, a revolt at the Capitol building in Washington. Shocking, horrible end to a tumultuous, chaotic, I call it the year of the pandemic. The wall, pandemic, what collapsed in the US and global economies, the broken pieces, of Humpty Dumpty. Today, in the inauguration and for what is to come, the new President Biden has started to put the pieces back together again. Unity instead of divisiveness in the United States. Dealing with, for the United States, nowhere near as well as South Korea has dealt with COVID-19, dealing with 400,000 plus deaths, a runaway pandemic, with a very poorly done vaccination program to deal with the pandemic and get more Americans inoculated. An economy that, as we left 2020 and entered 2021, after recovering sharply in the third quarter, was sinking, rapidly sinking and slowing in growth, threatening what we call a double dip, possibility of double dip recession. And longer run problems having to do with climate change, clear to the world, to immigration, broken, and the question of how to put back together a broken economy with what policies in a very divided and divisive, toxic atmosphere in Washington. Washington as a governance function, essentially a sham, not functioning at all. This is a big list of broken items. And that list includes the broken relationships of America with its longtime allies, ranging from allies in Asia to Europe to Canada. Yes, trade agreements, but not trade agreements with a great deal of substance, and of tremendous conflict with China, a kind of Cold War with China. Part of economic competition, because China is a force in the world, but the style and manner not constructive, in my opinion. Well, today I want to take a look, an objective, data-based, evidential look for you with the sense of US and global history that I have of politics and geopolitics, having traveled the world and lucky enough to meet with so many wonderful senior people in so many countries around the world, and to see the world through the eyes of economics, economic forecasting and financial markets, and the experience of a business person, an academic, a writer and an observer of history, and an analyst and a researcher. I want to be objective about it. And will say to you, as I've said before, my politics are independent. I've only once contributed to candidates in politics for the United States. I bring to my work objectivity, data, science. I'm happy to see that that will now gain favor here with the Biden administration and the biases and the advent of COVID-19, which makes us turn more to science and data and testing for our answers rather than opinion, lies, and fake news. I think that's behind us now. So I want to take you and look at the US and global economic and financial market outlook in the context of the US and the world, as well as in the context of thinking of all the broken pieces that exist for the US, the largest economy in the world, historically a leader in the world, an example, most of the time, a good example for so many countries, for so many peoples, for so many persons who come to the United States for opportunities, economic opportunities, because in our country, merit is valued and business looks for merit, hard work, and doesn't these days think that much about, as used to be the case, diversity. The here and now of what is broken is extensive and it's very gloomy. the here and now of most Americans and how they have felt is very gloomy. It is a gloomy Main Street story. A 6.7% unemployment rate, 18 million unemployed people, 23 million persons lost work in February and March when the pandemic hit. Only 11 million of them have come back to work. We have an army of unemployed that will stay for quite some time without work up until very recently, and still awaiting a American Rescue Act proposed by the new president, awaiting help on further support on income and on mortgage mitigation and relief. Yet with this gloomy Main Street, the worst numbers on the virus now, currently in the United States, highest number of deaths per day. Vaccinations very slowly being rolled out. The fighting in everywhere. And 2 weeks ago, an unprecedented attack on the Capitol building in Washington by Americans, not terrorists from overseas, Americans, unhappy and incited, many will say, by the then President of the United States, President Trump. It's gloomy. At the same time, even before today, Wall Street has been cheering. Indeed, around the world, equity markets are singing songs of happiness and cheer. But the here and now is terrible. How can that be? Well, theme one that I want to bring to you is rest easy. What you see happens in every business cycle, and it has to do with the psychology and the horizons of what goes on in the pricing of assets in financial markets, and what goes on in the heads of people who are suffering through the here and now of the kinds of horrible things that I described that are going on right now: economic illness, fighting, toxicity, divisiveness in our society. And so it feels terrible. Wall Street, on the other hand, looks ahead. The very essence of asset pricing is expectations about the future. May or may not be realized. But Wall Street always looks ahead. And in a recession, or we had a depression, or in very bad times, looking out 6 to 12 to 18 months at the prospects for the economy, for earnings, for interest rates, the things that make equity asset prices what they are today, and fixed income and currency values what they are today. They are in and of the future. And so the thinking of the agents in the financial markets has a horizon that's different from what we think in the here and now of living through the terrible and horrible, gloomy things that are going on. And on the expectation that the future looks brighter, that it will be getting brighter, an expectation that in the story of the next year for the US and the world, I will tell you, is our basic prospect, our forecast. On that expectation, the equity market can rise. Interest rates set pretty much by central banks stay stable. Markets will take interest rates higher in the United States during the next year. And you will see this apparent paradox, but it's not a paradox. I've seen it in every early stages of every single business recovery and expansion for decades. It's part of the business cycle and financial cycles, has to do with looking at the future. Now, if the future doesn't really have a good outcome, and this was the case during the Obama years on the fiscal stimulus of the Obama administration, which was short run and temporary, the equity markets did not sing great cheer, because those temporary fiscal stimulus measures, spending measures, in actuality, in my research and others, didn't really have much of an impact. But here, The bull market runs that we have had in the US starting in May, the new equity bull market that began at the beginning of this recovery, we think it started in the United States in May. And we think it's going to go on for a long time, 3 to 5 years minimum. If that is to happen, earnings will rise. And with interest rates told to us by our Federal Reserve to be set at 0, then the fundamental pricing of equities, which has to do with discounting future cash flows to the present with some discount rate, will give us rising on average equity prices and an equity bull market. What is stunning is how quickly this happened in 2020. The bear market was 5 weeks long. The new business cycle recovery began, we think, in the United States in May. The peak of the last one was February, about a month after I saw you. It came because of the pandemic and the shutting down of all kinds of businesses and economies around the world. You shut them down, growth is going to go down, going to go negative, which it did everywhere. And recovery started when we started to reopen, and the data tell us, the data that describe what goes on in the economy tell us that the US economic recovery began in May. And my God, we're already, I think, 8 months into that recovery. And in a recovery, we get the beginning of a new, in fact, sooner equity bull market, and that is what we are in. Wall Street cheers on future expectations, even while Main Street suffers. So the theme is, and I get asked this question all the time, not as paradoxical as it looks. You have to put on the visors of the future look on what might happen. And there, and theme number 2 for you from me, is that the US recovery is going to be sustained, and it is sustainable. It began in May. It continues. The recovery is undergoing a quite large decline in growth. For the fourth quarter, we're estimating just 4% growth, still positive. We could get a negative quarter in the first quarter. It takes 2 quarters of negative growth to define a recession. So we might flirt with what we call a double dip recession, or alphabet letter W, but we think it's sustained and sustainable. And I'm going to give you the story of why and what it needs to happen for that, so that we will grow slowly in the first half of this year, 2 to 3%, after a slowdown in the fourth quarter, accelerate strongly in the second half, very much so in 2022 with the expansion. And once they get going, recovery and expansion, in the United States, minimum of 3 to 5 years, minimum. And the last one went 10 years and 8 months. And with that goes an equity bull market. Eventually with that goes rising interest rates, first long-term rates, then short-term rates, when central banks begin to get restrictive. But it's the business cycle, and it's in process. Another theme, third theme is on this one, this time around, the global economy is coming into play in its, this is non-US economies, in its own upturned business cycle. China, and I think we all are somewhat suspicious of data from China. I'm not sure that's well taken, but China does appear to have stifled the pandemic quickly, even though it began in Wuhan province, through some very tough means of shutting itself down and keeping families home. That a governance system like the United States, our kind of democracy, our people will not do that. Even if the government decreed it, our people will simply not do it. And so, but China did get the pandemic under control. It started there. It was essentially over in the first quarter. And the Chinese economic recovery began in the second quarter and is now gathering steam, full force, very strong, sustained and sustainable. The Chinese economy was down in the first quarter at its worst, 6.8% year over year. The latest figure we got in the fourth quarter 6.5% plus year over year. That was above our optimistic 5.5 to 6% forecast. That's very strong. That is a swing in growth of 12, 13 percentage points. And in growth terms in the business cycle, that is a huge move up. China, as the second largest economy in the world and growing relatively, is a major force, particularly in your part of the world, that should help and is helping the Korean economy, should help and is helping the Japanese economy, that should help and is helping the Australian economy, Taiwan, Hong Kong economies. So that altogether in the global economy today, the proportion of GDP residing in those countries, particularly China, Japan, and South Korea, is over 25%. US GDP as a proportion of total world GDP is 25%. And so the tremendous improvement in Chinese economic growth, what it does to economies close to China, is as much a force and engine of growth for the world economy as is the US economy. It's just in the numbers. And so China is a major, major force. And there, the recovery, we think, will grow. And for 2021, we're expecting 7.3, 7.5% real GDP growth, 2021 over 2020. China does not have to lower interest rates anymore, so interest rates can stay stable. The growth is strongest in the world. The economy is competing quite well on trade. Its governance structure, while not the nature of a democracy or your South Korean governance structure, does seem to be working and helping the economy. And so we are thinking, we are very overweight asset allocation wise on the Chinese stock market, thinking it will go up 20 to 30% this year, depending on the measure. And we also think the Chinese currency will keep appreciating against other currencies, particularly the dollar, and are expecting almost down for the dollar down to almost 6 by year end against the Chinese currency. I mentioned China because it is an issue for the incoming Biden administration in terms of the conflict in economics and the very ambitious country that China is on a long run horizon. Which country will emerge as the biggest power, and will there be a Cold War that goes with it? I don't believe that. I think it'll be an economic kind of Cold War. There will be friction. There will be plenty of arguments, but I think both countries, it is in their interest to make the world a better world in economics for their people and for everybody else. So I come out positive on that. And then another theme, equity bull markets in the US and elsewhere. With this view of recovery sustained in the US and in the world economy, it follows that we are bullish on equities on a relative value basis. Let me summarize a few numbers, bottom line numbers, and then briefly go through the story of the US upturn, what it has to happen for that sustained recovery and expansion to occur, what we have to watch, and how we are thinking about it. On economic growth for US real GDP, these are fourth quarter over fourth quarter forecasts. 2020, the US economy looks like it collapsed by 3.5%. That is a 1930s depression-like figure. In 2021, this year, particularly the second half of this year and going into next year, 4.7% Q4 over Q4. That's a swing of 8 percentage points. It's a huge improvement. 4.7% is above our historical trend. That's a very strong economy that we're looking at, and I'll give you the story behind that in just a few minutes. In 2022, 4.2%. 2023, 3.5%. That's the minimum 3-year recovery and expansion. I actually think it'll go on longer than that, given the kinds of policies that the Biden administration and the US will put into place and how that is going to lift the mood and attitude of America and allow us, under the leadership of President Biden and his administration, to put the pieces back together again with our trading partners and our global alliances, which were shattered by the bull in the China shop, if you know what that phrase means, ex-President Trump. Chinese, I gave you the China growth numbers. 2022, 7.5% could be as much as 8%. The Chinese economic momentum is accelerating, and we think it will keep on doing so. South Korea was down 2020 estimate down 1.1%. Q4 over Q4, that's a big decline for South Korea. This year, 3.2%, and next year, 2022 over 2021, 3.5%. Those are two very strong years for South Korea. Business should be strong and solid. And Japan, after having plummeted in real GDP in 2020, down 5.3%, up 2.7%, Q4 over Q4 2021, and over 3%. Also, part of Asia accelerating. With the growth rate and the expansion that I've described for the United States, earnings, and we measure earnings by the S&P 500 operating earnings, went down in 2020 by 14.5%. That's the bad year. We're estimating up 25% in 2021 and up 9 or 10% in 2022. It could be more. Given zero interest rates, essentially zero interest rates from ultra easy monetary policy by our Federal Reserve well into 2023, and a rising 10-year Treasury rates rising to 1.5% by the middle of this year, perhaps 2% end of this year. Those are still very low. We currently mark the fair value for the US equity market. It's a function of earnings projections and interest rates at point fair value 37.75. I think we closed today at 38.50 on the S&P 500. Upside is 4,100. There's a downside risk on potential correction, which we would get if we got a double dip recession. 6 months from now, that fair value looks like it will be just under 4,000, 39.50, upside of 4,300. And about 1 year from now, toward the end, later in 2021, we think the fair value for the S&P 500 will be 4,100 to 4,200. That's about a 10%, 8 to 10% increase from here. It's a good year, not as good as 2020 with all of its volatility. It's a good year, and it makes the U.S. equity opportunity an overweight on the global horizon. On asset, the Chinese equity market, depending on the measure, we're forecasting up 30% for this year. These are shockingly strong numbers. Remember what I just said about the Chinese expansion, how it's going to go on, and the trade, strength and trade of China. South Korea, 35% is our forecast for the gain this year in the South Korean equity market. And Japan, plus 20%. That says that in global asset allocation, I and lots of other people are telling all investors to be overweight in Asia, particularly those countries, and with regard to the Chinese stock market, to be unhedged because we think the Chinese currency will go up. And depending on the currency that you're based in, Chinese improvement in the yuan, that's for dollar-based investors, will get you some added return. For the US, for broad asset allocation, these are bottom line forecasts that I know all of you are interested in. So I'm giving it to you early. Asset allocation for the US-based portfolio, strong overweight, 80%. This is relative value now. This is not with a constraint of, say, 60-40 balance in a portfolio that so many institutions have to adhere to. 80% equities against a 55% neutral bogey. That's a strong overweight. 15% fixed income versus 35% neutral, because long-term rates are going up and you lose principal on that. And underweight on cash and equivalent, 5% against 10%. We are looking at commodities as an alternative asset class to be overweight commodity prices, to be overweight on commodity price inflation. Crude oil, now an overweight for us, not a neutral minus. Private equity and venture capital, overweights across alternatives, and the amount of funds that come from standard asset allocations into the alternatives depends very much on institutions, anywhere from 7% to 25%. So the alternative asset space in an expanding economy, recovering then expansion, 3 to 5 year horizon, lots of business opportunities globally around the world, with the world economy coming on stream, so that in 2022, we have a very strong global upturn. We like alternatives. Well, let me quickly give you the, yes, this is Seoul, Korea, and the US dollar, which is of interest to all of you. We are neutral to negative on the US dollar. I think I've given you our view of a dollar against the Chinese currency, somewhere around 6 by the end of the year, from the 646 or so currently for the Chinese currency against US dollar. Dollar yen, a little over 100, almost parity. Dollar euro, 126, and the Korean won, 1048. Now, remember, these forecasts have pretty big standard errors around them, ranges. So point forecasts almost never happen because it's part of a range, and you should keep that in mind. I've given you the US interest rate numbers as well. Well, how does this all happen? The current state of things entering 2021 for the United States is that we are undergoing a major downshift in growth. In the United States, a surge of COVID-19, not just in the United States, in the world, and new virus mutants have brought new restrictions and lockdowns, and that is interfering with consumer spending and business spending, along with the natural retreat from what was a 34.5% rebound in the US economy in the third quarter. While these lockdowns and restrictions are nowhere near what the world experienced in February, March, and April, where the world economy basically was shut down by public health authorities and governments because of the lives that were being lost and the unknown nature of the illness, it's still enough to be creating slowdowns in countries where these spikes and the new waves of illness are occurring. In addition, there's tremendous hesitation on the part of consumers in so many parts of the world because of the illness and the risk associated with it. Although monetary and fiscal policy settings are extremely stimulated, ultra easy monetary policy in the United States and the largest fiscal stimulus ever, $3 trillion last March, 900 billion of additional stimulus in the last week or two out of Congress, and a proposal for 1.9 trillion, which would be enacted in the first quarter coming from the new Biden administration. We're estimating 1.5 trillion of that will actually get through. That stimulus lags in its impacts, and so the sweep of the downturn in growth is going to continue into the first quarter, and then should abate as the reopenings begin to occur on a diminishing and waning, that's an assumption, diminishing and waning of the COVID-19 illness in the United States, plus a lot more vaccinated people. And so businesses, maybe around March or so, will start to reopen. That's an exogenous lift to the economy. There is tremendous, what we economists call pent-up demands on the part of consumers, tremendous amount of spending. And those consumers who are working, there's a whole lot of those, are saving a lot. 12.7% is their saving rate. And they're going to have the wherewithal, once it's safe, to go out and spend a lot of money. They'll be traveling like mad, spending on lots of consumer goods, visiting their families, things they can't do now. Pent-up demands is like an exogenous lift in consumption. That's 70% of the US economy. And probably I'm talking about 40, 50% of the consumers. That should lift the economy. And we should move out of a 3% or so slow growth rate in the first half to a more aggressive growth, 4, 6, 7% in the second half, and enter 2022 with a lot of momentum. The army of unemployed, those 18 million unemployed people, we don't think will be taken back into the workforce very soon. There are 3 reasons. That army of unemployed in the United States and a sticky high unemployment rate is going to stay. It's going to stay. Because number one, companies don't need as many workers as they needed before. Technology is being substituted. Number two, workers cost money, and companies try to maximize shareholder value, which means you want to keep the labor costs down and profit margins up. That in turn helps the stock price. That's part of why we see so many unemployed. And at the same time, we see stock prices going up because the increased profits help raise stock prices. We also have what I call the new technology, an incredible wave of new technology, which has been speeded up because of the pandemic, how we work, how we live, how we communicate, how we plan, how we visit. This Zoom conversation without the travel that goes with it, and with all of you hooking in from wherever you hook in order to have access to this talk. It's a rewiring of the world that's going on, a digitization of the world. It is, in my view, the technological change that I am giving a few examples of. There are many more. The Alibabas of the world, which is like, they're like Amazon. The chip producers, NVIDIA, the communications, the payments companies. They're not just US payments companies, like Square, which is now a bank. I'm giving examples. These are not recommendations. I'm not allowed to give recommendations on individual stocks. These are examples of the kinds of changes that are going on that are electrifying. They're beyond our comprehension. We call it technological change. Technological change reduces costs, reduces price inflation, and what it has done in the United States, technology and the technological changes, it has revoked the relationship our central bank was using for decades that had as a view a falling unemployment rate raises inflation. So when the unemployment rate approaches full employment, you raise interest rates because inflation is coming, you have to head it off. Chair Powell and the Federal Reserve have rejected that because that's wrong. And technology has lowered both inflation and the unemployment rate. And on August 27, 2019, Chair Powell made that very clear. And the Federal Reserve has since abandoned the Phillips curve with that relationship, and they are now saying they're going to act to keep inflation above the target 2% and make sure it's above 2% for a while until we get the unemployment rate to full employment. That's the main goal now, to full employment. Well, that means ultra easy monetary policy forever. It's a total change in forward guidance. And I would expect other central banks will follow suit because everywhere in the world, deflation is seen with low unemployment rates. Well, now we turn to monetary policy as a key element in the story of sustained recovery. The reopenings, pent-up demands by consumers, particularly, businesses responding to that, the ultra-easy monetary policy, which is going to be sustained, and then we have the fiscal stimulus of the new Biden administration, the latest proposal we are assuming will get passed now because there's a slim Democratic majority in the Senate, there's a Democratic majority in the House. President Biden is very good at getting people to work together, and the US economy looks like it really needs a stimulus. So they will quibble over the amount. So we're assuming $1.5 trillion of stimulus, and it is classic demand, Keynesian government generated stimulus. It is deficit financed with accommodative monetary policy, and it will have the biggest impact of any fiscal policy with that kind of financing. And yes, the deficits go up, the debt goes up. Someday we're going to have to deal with that when inflation interest rates rise, not right away. But this is pure Keynesian stimulus in an economy where lower interest rates have not raised the economy, and the pandemic knocked us out of the box. And that's exactly what they should do, and it's coming. The total fiscal stimulus will be then, if we assume $1.5 trillion, they're proposing $1.9 trillion. The total fiscal stimulus will be $4.5 to $5 trillion, and that's 15 to 20% of US GDP. Nothing like that has ever happened, fiscal stimulus in the United States. And you know what? It's going on in other parts of the world too. Japan, huge fiscal stimulus program. South Korea, some, but the US is incredibly large. So the US economy has this plus easy monetary policy going for it, and the mechanisms of the business cycle. So our view is we will have sustained recovery and expansion. We will accelerate next year into the next year. The world economy as another element will come on stream. And at the end, we have, going with all of that, equity bull markets.
Okay.
Plenty can go wrong, and I'll close with some of those. Pestilences, floods, pandemics. Look, when I was with you last January, I was very optimistic. And did I know about the COVID? I will say this, in Seoul, I saw more people wearing masks than any time in January I'd ever visited Seoul. But I did not put two and two together that we're about to get knocked out by this incredible, unprecedented COVID.
Okay. All right. Thank you, Ellen, for your brilliant opening speech. And our audience and viewers must have recognized that you have such an optimistic and bullish sentiment about the global economy and the financial markets down the road, at least for the foreseeable future, thanks to historically strong fiscal and monetary stimulus, as you have described, and also technological advancement, and all those positive factors behind this will help stimulate U.S. economy, the largest economy in the world, and we have a strong recovery in China and elsewhere as well. So altogether, you're looking at from gloomy to cheering economic environment and also financial market condition. That's the essence of your presentation. And our audience would appreciate not just your optimistic view, but what's behind this prediction, forecasting, and the logic and the reasoning behind this would be very important to understand. Thank you very much for your closing comment on Keynesian, typical historic Keynesian stimulus program. I hope you're right. We'll see how it goes by this time next year. But I certainly hope your views prove to be as accurate as possible. Now, we have a very limited time for Q&A. First, I would like to have Professor An Chung-young, who's a very respected economist and also served in the government before. He's online, connected to this. So I would like to welcome him for his quick comment or question. And then I would like to follow up with some questions that I have received from press and other sources. Is Professor An there?
Yes.
Okay, please. Okay, thank you very much for joining us this morning.
Okay.
Say hi to Dr. Sainai.
No, I see you there.
Both
Hi.
know each other for a long time.
Okay.
Yes,
Well, Dr.
absolutely.
Sinai, Happy New Year.
And nice to
That's
see
a
you
very
again.
good start. And it is always my great pleasure to begin my own year by listening to your very comprehensive, insightful forecast on the world economy. Well, I really hope that President Biden is successful to put all the broken pieces together for the global recovery. Well, after listening to the assessment on China, I would like to explore further on the US-China relationship because that is very deeply connected on the Korean economic outlook. Amid the pandemic shock, China has managed very well, as you pointed out. And the last year, China scored a tremendous strategic victories over the United States by concluding regional economic comprehensive partnership and then signing the China-EU, the investment treaty. Both mega deals really strengthen China to poise herself as the center of the regional, maybe global, the supply chain, as all the Asian economies are deeply, deeply linked to the China's regional supply chains. So on this regard, I think my question is that the Biden administration is going to carry on China bashing policy, even including decoupling China. And then the question is that the US and China will go through the die-hard collision course, even under Biden administration, or maybe two countries may the compromise to reflect, to embrace the interest of both sides. So what's your view on this? My view is that although Biden administration takes very harsh containment policy against China, but its impact would be very much limited because of China's ongoing speedy recovery. And second, the RCEP, the effectuation, and the third, the EU and China, the investment treaty. So what's your view on this? And further to this question, how soon do you think the US will return to the Trans-Pacific Partnership Agreement, perhaps with some further round of negotiation? Thank you.
Those are
Thank you
great
for your
questions.
question. Yeah, Ellen? Yeah.
Those are great questions. I think an answer at this stage depends on one's view of the president, the kind of person he is, the kind of people around him, and a style of operation. And what is going to be so striking for the world and all of you, because we're now used to 4 years of an aberration, President Trump and his style. Indeed, a psychologically disturbed man. That's what the psychiatrists say. I think that's easy for me to say, and I said it long ago. A demagogue. And the relief in America that he's gone, the bulk of Americans, is hugely noticeable. You have to be here to feel it, to see it. We were run by a president who was a madman. And he was totally ineffective and never ran the business well either. And somehow that happened. Now, I think it happened because America was on a very bad road. We have a lot of problems, not just economic. We have tremendous problems with disenfranchised people. A lot of things came out, which is a plus of the Trump years, like systemic racism, the police killing of blacks, innocent blacks, and Americans were shocked. By the way, it's another technology. Cameras showed us stuff that we never saw as citizens, and most Americans were appalled and shocked. And then you had the behavior of President Trump. You know, one of the reasons for the stock market rallies is the craziness is gone. The unpredictability is gone. Would he press the nuclear trigger and shoot the North Korea out of the sky in a moment of madness? Americans feared that. President Biden is very different, and the whole style is very different. Now, the style is in part a reaction to how appalled the bulk of America is at what happened to us in the last 4 years. You need to understand this about the psychology of America, what I'm saying. Yes, there's a fringe right. They're the people who attacked the Capitol. But the bulk of Americans want unification. They don't want the toxicity. They don't want the divisiveness. And Joe Biden, for some reason, accident of history, is just the right person for that. Now, we got lucky that someone like him was around. And his style is, and of course, I have to study the people who are going to affect economies and policies and kind of get into the head of the person. I think I understood Trump. He was a madman. We're lucky we got out with nothing worse happening. He would have won if not for the pandemic and his inability to handle that. The economy was in good shape. His policies helped the economy be in good shape. And he's a great salesperson. He has a cult following. He's a cult leader. He's the kind of leaders that we've seen in Latin America. He had Hitler-like characteristics. I'm not just saying that from my own opinion. This is evidentially based. Plus, I talked to plenty of psychiatrists in Cambridge, Massachusetts, which is close to where I live. They're all over the place because they treat each other. I kid my psychiatrist friends in Cambridge, Massachusetts. But Biden is totally different. Biden comes from a different background. His father was a miner. He has had tragedy in his family. He understands what it's like to lose loved ones. He is a devout Catholic. He's a moral man. He's been in politics 47 years. He is by nature a conciliatory person. He is by nature, as I am, optimistic. The older I get, the more optimistic I get. I'm not quite sure why that is, but I have to call it as I see it. And I am looking at the morning of America, the dawning of a new time for America. Everybody else is miserably worried, and I'm really optimistic about the future of America. Part of it is on my reading of the man. Now, I look to see who we appointed around him. Did he really do the diversity he says we need to have? He really did. Did he go far left, progressive left? No, he did not. Secretary of Labor is the mayor of Boston, an ordinary guy. He's not Bernie Sanders, who wanted the job, a progressive left-wing liberal, terrific senator, but he belongs in the Senate, and certainly not from the right side of the ledger. He appointed an incredibly competent Treasury Secretary. I know Janet Yellen for 50 years, professionally and personally. She's not at the Fed now. She's not at the Fed now. She doesn't worry about inflation the way she used to. She is a full employment advocate and maven. She grew up and was trained by Jim Tobin, one of the great liberal economists of all time. She is going to work hard to get full employment, and inflation can go higher. That's very bullish. She is also very concerned about inequality. So the sequence of their policies, his appointments are center, slightly left. They are experienced, competent people. The business of America will run like a business now. They are working right now as we speak. They are not playing golf. This is a hardworking crew. They're all experienced. It's the beginning of something very new. Now, when that comes to China, I think you can expect something not confrontational. It won't be the style of Trump, it won't be confrontational. It'll be firm, speak softly, carry a big stick. The big stick will be tariffs. Big stick will be trade. The big stick will be tough conversations with China. It'll be getting America to compete more and using policies to help us compete more. But it will not be a vicious Cold War that will send us spiraling into a bad downturn. I do not read China as that way. Now, unlike a lot of people, I see China as trying to be, in many ways, responsible global citizens. That comes with being and wanting to be the most dominant country in the world, which is how I view China. You can't be a renegade. You can't be criminal. You can't have horrible pollution. You can't do things that have your people riot, like Tiananmen Square. You certainly can tell them to lock themselves in their houses and take care of the pandemic. But the Chinese technocrats, the people who run China, are very impressive. And I am hoping that our people in Washington, I think they are, all the appointments of Biden that I've looked at, are really, really career, dedicated, hardworking, honest people following his lead of transparency and honesty. So I do not think we're going to have a big war with China.
Okay, with that, Alan, sorry to interrupt, Professor An. Our time is now very tight, but I'm compelled to raise one or two final questions reflecting on feedback from the press. So I'll raise that question with Dr. Sinai. First is you mentioned the dollar's weakness, not strength, throughout the course of this year. But the recent indications are that, including the Senate hearing for Janet Yellen, it appears that this Treasury and the Biden administration are unlikely to tolerate for the weakening of US dollar. So the market reacted along that line. And so general indication in the market is that rather than weakening, but strengthening or at least steady against Chinese yuan and other major currencies throughout the year. Now, I respect your view, but could you please elaborate on why you feel strongly about neutral to weakening US dollar very quickly?
The Chinese economy is growing faster than any other economy in the world. It's headed to be the largest economy in the world, although the measured GDP may not be that good. The trade balance, that's the supply and demand of currencies, is very strong. It will become increasingly part of the reserve currencies of the world. That's demand for that. And Chinese interest rates are positive. US interest rates are zero. Japanese interest rates are zero. These are the short rates. Europe rates are zero. They're going to stay that way for a long time. So the interest rate differentials favor the Chinese currency. The Chinese currency will get stronger, and China will want their currency to be stronger as a major reserve currency. That's the main arguments having to do with the dollar weakness against the Chinese currency. The effect of China and the growth of Japan and South Korea. South Korea, our view is that rates will stay the same. There'll be a hold on rates because the economy is doing well in South Korea and will do well. And so interest rate differentials will favor South Korea as well. So those are very modest declines in the dollar against major currencies. The big movement is more against the Chinese currency. And then you get to the future of the country. As a global investor, where do I go? Well, I think on a shorter one-year basis, I gave you one-year forecasts. The allocations to China, the China stock market, will, in a global broad asset allocation, will get greater. The allocations to the EMG will get greater because these parts of the world, the stock markets are going to be appreciating probably faster than the US. And that's part of the dollar weak tone. I am not talking about a collapse of the dollar. I believe the Biden administration, the Treasury Secretary, will let the markets call the tune on the currency, and they will not say much about it at all. It'll be a Bob Rubin approach. The markets will call the tune on the currency. And right now, the market forces, as we look at them, say that the dollar ought to be on the weakest side on a one-year horizon.
Okay, fair enough. Last question that I have is that we have a number of distinguished viewers for this webinar. Actually, all the viewers for our program are very special, but I have noticed that CEO of the leading financial group in Korea, and also I noticed the chairman and CEO of leading textile group in Korea as well. Now, although you didn't talk about much about growth prospect or any issues related with the specific sectors, industrial sectors today, but would you have any sort of comments or suggestions?
Well, sure. Certainly
industries?
on sectors, yes. Textiles, this is a mixed year. This is a transition year because we're exiting the COVID sensitivity and the shutdowns, the lockdowns, and mixed growth rates around the world. But 2022 globally should be a very strong year in terms of volumes of demand coming from all segments of lots of economies. And that speaks well for textiles from a volume point of view. Now, technology of materials and how we wear clothes and all that, the kinds of things textiles go into, I don't think is long run favorable to the textile sector. But the global upturn, perhaps 4 to 5% in 2022, should be good for the business of textiles. In fact, for all businesses all around the world, should be a stellar year. Remember, we have had a horrible year in 2020.
Right.
We had depressions throughout the world, tremendous volatility. In the United States, we had an incredibly strange political climate. We have been through awful stuff. We had bear markets, bull markets. We had the pandemic. It could get worse, but it's not likely to get worse. Economies' natural propensity is to grow. Policies are set into place to make them grow. Then think the next thing we're going to worry about several years, 4 years down the road, maybe too much inflation and booms. As an outside scenario, I think 3-4 years down the road, the world economy could well be booming.
Okay. Final word on financial sector, including banks.
Oh, well, we're on the U.S., we're certainly positive. We see in our forecasting the steepening of the yield curve. It was around 70 basis points, 2s to 10s. The yield curve steepens. The financial institutions that are in the trading world, as well as in the lending world, the margins are going up substantially on loan volume. Now, banks and investment banks don't lend as well as they used to. So any institutions that lend, what are called shadow banks, Square is a company. It used to be a payments, but now it's in the lending business. The global payments companies are in lending businesses. One that's like that is American Express, Visa. But there are global payment companies that have monies that come in that don't cost anything, and they can lend them out. That steepening yield curve on the US dollar basis is very, very helpful. Eventually, other economies' yield curves will steepen as well, but we don't see that happening in Japan or probably not South Korea this year.
Thank you very much on behalf of our viewers, audience, and our members. I would like to thank you, Ellen, for your brilliant speech and very stimulating Q&A session you have had with us at this very late hour in Boston. Thank you very much indeed. And also, I'd like to thank our viewers. Thank you very much.
I want to thank you very much. It's been a delight for me to talk with you.
Next, we'll we'll meet in person rather than virtually.
Yes.
Perhaps by the time you may change your hairstyle again. I'd very much
Well,
look
why don't you
forward to
tell me
seeing
what
you.
you tell? I'm thinking of vote. Which
Okay.
listen,
Well,
I'm
see,
happy.
let me
I'm
think.
happy
Let
I
me
have
think.
here. I'm happy I have here.
Okay. All right.
There it is.
Okay. Bye now.
Bye. Thank
Okay,
you.
thank you.